Hello, everyone. You are watching Smart Capital, the School of Financial Literacy.
Yeah, welcome back, everybody.
And today we're doing a really exciting deep dive into a topic that, honestly, I think a lot of people get wrong.
Oh, absolutely. We see it all the time.
Right. We're talking about how to separate the truly great stock investments
hmm
from the companies that they just look flashy.
Yeah, we want to give you a real step-by-step framework to evaluate what we call blue chip stocks.
Exactly.
Yeah,
Because we all want those safe, reliable, compounding machines in our portfolio.
right. But there's a huge trap here. I mean, just because a company has the blue chip label, meaning 10 plus years of consistent profitability, global scale, an investment grade balance sheet.
The big names, basically.
Yeah, the big household names. That doesn't mean it's the right buy for your portfolio today.
Right. And, before we continue, I'm curious how many of you are already interested in financial education or investing? Let us know in the comments.
I'm always really interested to read those, actually.
Same. So, to really understand this blue chip illusion, let's look at a piece of market history that people kind of conveniently forget.
Oh, you're talking about the year 2000.
Exactly. The dot-com bubble. Let's talk about Cisco Systems back then.
Yeah, I mean, Cisco was the ultimate blue chip stock at that time. It was the absolute darling of Wall Street.
Didn't have the highest market capitalization in the entire world.
It did. It was viewed as the safest, most inevitable investment you could possibly make.
Because they were building the backbone of the internet, right?
Exactly. The internet was going to change the world, and it did. But if you bought Cisco at its peak, it took you over 2 decades just to break even on that investment.
Wow, over 20 years of dead money.
20 years. All while holding one of the most famous, successful companies on the planet.
Which just goes to show a legendary company does not automatically equal a legendary investment.
Exactly. And that's our mission for this deep dive. We are building a ruthless mechanical framework to look past the brand names.
So where do we start? Let's get right into the framework.
Well, we have to isolate specific financial mechanics.
Mm.
So we start with the engine of the business, which is top line revenue growth.
Okay, so revenue, not earnings.
Right. Strictly revenue. For a mature blue chip company, we really want to see a 5-year compound annual growth rate, or a CGR, sitting comfortably above, say, 5 to 8%.
Okay, let's unpack this. Why are we specifically isolating revenue and temporarily ignoring earnings per share? Because Wall Street is notoriously obsessed with earnings.
Oh, totally. Every quarterly earnings call is just people obsessing over whether a company beat or missed their EPS estimates by like a penny.
Right. The stock swings wildly based on earnings.
It does, because earnings dictate short-term price movement. But the problem is earnings are heavily subject to financial engineering.
They can be manipulated.
Exactly. What's fascinating here is that this growth has to come from real demand, not just clever accounting adjustments or cost cutting.
Because management teams have a ton of ways to massage the bottom line, right?
Oh, dozens of ways. They can capitalize expenses that should really be operating costs, which hides them. They can extend depreciation schedules on their physical assets to artificially pump up short-term profits.
And buybacks, we see that all the time.
Yes, massive debt-fueled share buybacks. They reduce the number of outstanding shares, which magically makes their earnings per share look fantastic.
Even if the underlying business is completely stagnant. So it's kind of like they are shrinking the pie into fewer slices to make each slice look bigger rather than actually baking a larger pie.
That is a perfect way to put it. You just cannot fake top-line revenue growth over a 5-year horizon.
It's the unvarnished truth.
Yeah. If that revenue CAGR is above 5 to 8%, it proves that consumers are genuinely demanding more of their product.
But I mean, raw growth isn't enough on its own, is it?
No, definitely not.
Because a company could just slash its prices to the bone, spend $1 billion on aggressive marketing, and double its revenue.
Right. They could completely destroy their profitability just to capture market share.
Which brings us to the efficiency of that growth.
Exactly. And that is measured by return on invested capital, or ROIC.
ROIC. So how does that work?
ROIC is arguably the most definitive measure of a company's competitive advantage. It basically asks, how efficiently does management take the capital they raise and turn it into actual profit?
So what numbers are we looking for here?
In the blue chip space, maintaining an ROIC of 10 to 15% is really strong. Anything sustaining above 15% is elite.
Okay, so think about it like a restaurant,
Oh, that's a good analogy.
right? So if a really successful brick and mortar restaurant wants to grow its profits by 10%, they can't just snap their fingers.
No, they have to spend a fortune.
Exactly. They have to go out and secure commercial real estate, navigate zoning laws, physically build the new location, hire all new staff.
It requires a massive outlay of capital just to generate a tiny marginal return.
But then you compare that to a company with an elite ROIC, like a Microsoft or a Visa.
Yeah.
They just replicate a successful digital model. It scales incredibly cheaply.
Yeah, historically, they just crush this metric. Because when transaction volumes increase globally, Visa doesn't need to pour concrete and build new infrastructure every time a card is swiped.
The network is already there.
Right. The incremental cost of processing one additional transaction is practically zero.
So they scale their revenue without scaling their capital requirements.
Exactly.
That makes total sense. And hey, if you enjoy clear and simple explanations of financial topics like this, give this video a like so we know you want more content like this.
It really helps us out.
So we've got the growth engine sorting. We want real revenue growth and elite ROIC.
Right, but an efficient engine is great when times are good. What happens when the economy stalls?
Yeah, that engine needs protective armor to survive. Which brings us to the second part of the framework, cash and debt.
Yeah, we have to shift from growth to resilience, starting with free cash flow.
Because cash is king.
Cash is the true fuel for a healthy business. It's the hard cash left over after a company pays its operating expenses and capital expenditures.
Because at the end of the day, you can't pay your employees or your suppliers with adjusted EBITDA.
No, you need actual liquid cash. It funds buybacks, dividends, acquisitions, innovation. A lack of cash flow is basically the number one reason businesses get into trouble.
Do we have a good example of a cash flow machine?
Apple is the classic example here. They have this massive free cash flow engine.
Because they have such huge global sales volume.
Huge volume, but surprisingly low capital intensity because they outsource so much of the physical manufacturing.
Right, Tim Cook really mastered that supply chain.
Exactly. It generates a mountain of free cash flow, which is their defensive armor.
And the primary threat to that armor is debt, right?
Absolutely. When we look at debt to equity and interest coverage ratios, we're looking for survival.
Because most of these massive blue chips carry billions in debt, and honestly, Wall Street usually doesn't care.
Right. It doesn't bother Wall Street until the credit cycle shifts.
Until rates go up.
Exactly. Having debt is completely normal. The danger is the refinancing wall.
Oh, the refinancing wall. Explain that.
Imagine a highly leveraged blue chip that issued billions in bonds when interest rates were near zero.
So they're basically paying nothing in interest.
Right. But what happens when those bonds mature and they have to roll that debt over? But now interest rates have spiked to 5 or 6%.
Oh, man. Their interest expense just doubles or triples overnight.
And that completely cannibalizes the free cash flow I just talked about. The cash that was supposed to fund innovation or dividends is now just going to service the debt.
They go from playing offense to playing defense.
Exactly. But contrast that with consumer staples like a Procter & Gamble or a Johnson & Johnson.
The companies making toothpaste and soap.
Right. They maintain very manageable debt relative to their massive cash flow.
Which makes them highly resilient.
Yeah, a sudden freeze in credit markets or a rate spike just doesn't threaten their solvency. They don't rely on constant cheap borrowing.
Okay, so let's say a company passes all these tests. Great growth, elite ROIC, plenty of cash, low debt. It's basically a masterpiece. Does that mean you should buy it immediately?
Not exactly.
The catch.
Yeah, this brings us to the reality check. Valuation. Even the best armor and engine are useless if you pay 10 times what they're worth.
Right. Valuation is the great humbler in the stock market.
It really is. It's where seasoned investors destroy their own returns. We influence the PE ratio, the price to earnings ratio.
That's the classic metric.
It is, but more importantly, we look at the PEG ratio.
Which is the PE divided by the growth rate.
Exactly, and the free cash flow yield. Because paying a PE of 30 might be totally fine for a company growing at 30% a year.
But paying a PE of 30 for a legacy business growing at 2% is a disaster.
Yeah.
But let me push back a little here, because what about a legendary stock like Coca-Cola?
Okay, the Buffett example.
Right. Warren Buffett made an absolute fortune on Coca-Cola. He bought a massive consumer monopoly, held it forever, and got incredibly rich. People use that as an excuse to ignore the PE ratio, saying it's a forever stock.
Yeah, I hear that narrative all the time, but it completely ignores the reality of when Buffett bought it.
The timing matters.
Hugely. When he was loading up on Coca-Cola in the late 1980s, The company still had a massive, untapped runway for global expansion.
Oh, right. They were just moving into all these international markets.
Exactly. He paid a fair price for explosive growth. But Coca-Cola today is vastly more mature than when Buffett bought it.
They're practically ubiquitous now. Everyone has a Coke.
Right. The hypergrowth phase is behind them. So a great business at a fair price often beats an amazing business at a crazy, overvalued price.
You're paying for past glory instead of future potential.
Precisely. You have to match the stock to the current economic environment.
Right, because different environments call for different stocks.
Definitely. If we're in an era of AI and tech dominance, you're going to look at Apple and Microsoft.
Because they have that balance sheet strength plus the innovation to keep pushing forward.
Right. But what if we're dealing with high volatility and higher interest rates?
Then you want a company like Visa.
Exactly. Because they have strong cash generation, diversified revenue, and massive pricing power. Since they take a percentage of transactions, they naturally hedge against inflation.
And what if the market is flashing red for a deep recession?
That's when you retreat to recession resilience. Your J&J or P&G.
The consumer staples.
Yeah, because demand is stable regardless of the cycle. People will still buy medicine and diapers even if GDP shrinks.
Right. Imagine you were in this situation. What decision would you make? Write your thoughts in the comments. Would you choose an expensive tech stock with high growth or a moderately priced consumer staple right now?
That's a great question for the audience.
So we've measured the financial health, we've checked the valuation. Are we done?
Not quite. The final step is what we call the 10-year test.
The 10-year test.
Yeah, it's about measuring your own conviction as an investor to ensure you can actually hold the stock for the long run.
So what are we asking ourselves here?
The ultimate qualitative check.
Hmm,
Will this company still dominate its industry in a decade?
right.
Do they have real switching costs? Or deep brand loyalty?
Like, it's easy to switch toothpaste brands, but it's a nightmare for a huge corporation to rip out its enterprise software and switch to a competitor.
Exactly. That's a massive switching cost. And the other question is, would you feel comfortable holding it if the market suddenly dropped 30% tomorrow?
Oh, the gut check.
Yeah. If your first instinct is to panic sell, you never really understood the business.
You were just renting the stock because the line was going up.
Right. If we connect this to the bigger picture, it means being absolutely ruthless with your current portfolio.
You have to trim the fat.
You do. If a legacy stock you bought 5 years ago no longer makes sense, especially compared to just buying a simple S&P 500 index, you need to cut and trim it.
No emotional attachments to ticker symbols.
None. Which brings us to common mistakes to avoid.
Oh, there are so many.
Number 1, buying just because a stock is famous or because someone else bought it.
Billionaire X bought this, so I should too.
Right. Totally ignoring that the billionaire has a completely different risk profile than you do.
And another mistake is just chasing recent performance.
Right.
Ignoring that 10-year horizon.
Exactly. And the big one, concentrating too much in one sector.
Oh, like last year.
Yeah. Investors went way too heavy in tech and AI last year, completely ignoring valuation.
And then they suffered huge drops early this year when reality set in.
Exactly. They have no defensive armor.
Right. And hey, if you're interested in financial education, investing, and understanding how money works, make sure to subscribe to the channel. We regularly break down complex financial ideas in simple terms.
We definitely try our best to keep it actionable.
So what does this all mean?
Well, it means building a resilient portfolio requires looking past the hype.
Right. Every stock in your portfolio needs a story or a justification.
Yes, whether it's their elite ROIC, their massive free cash flow, or an incredibly attractive valuation.
So what's a practical starting point for someone listening to this?
A really simple strategy is just to pick 4 to 5 broad sectors, say technology, healthcare, financials, consumer staples.
Okay.
And within each sector, pick just 1 to 3 solid blue chip stocks that pass this framework.
So you're diversified, but still focused on quality.
Exactly. Alternatively, if doing all that fundamental analysis is just too complex or time consuming,
Just buy the market.
right,
Yeah.
building broad ETFs like the S&P 500 gives you exposure to that growth with sustainable downside protection built right in.
It naturally weeds out the losers over time.
It does. But I do want to leave the listeners with a final kind of provocative thought to ponder.
Oh, I like these. Let's hear it.
Think about this. As more and more people default to passive index funds, trillions of dollars are just blindly funneling into these mega cap blue chips.
Completely ignoring valuation.
Exactly. The algorithm just buys the biggest companies, regardless of their ROIC or PE ratio.
So it's like a feedback loop.
Right. Next time you look at your portfolio, ask yourself, are you holding on to yesterday's winners out of nostalgia, or are you investing in the financial engines of tomorrow?
That is incredibly profound. Thank you for watching this video all the way to the end.
If you enjoyed this discussion, subscribe to the channel, leave a like, and we'll see you in the next breakdown.